Okay, welcome to the Wall Street Crossover Show with myself, Zach Meir, and Craig Drake standing in for Darren Sinden, even, of Admiral Markets. Right, chaos yesterday. I obviously shouldn't stay away from Tip TV because whenever I go, the markets go mad. But today, any more stability today?
Not really. With kind of Greece, as we go now at the moment, Greece is still kind of fighting over a last-minute kind of compromise agreement that's been tabled, which will allow them to repay part of their debts and avoid complete default, because we've got the IMF deadline that's kind of rapidly appearing this afternoon. And it's quite interesting when you look at what's happening in the markets. Yes, markets are down. Yes, we've got volatility, but the markets are still not pricing a Greek exit. What we're seeing at the moment is a long way short of what we would have if people genuinely thought that Greece is about to leave the Eurozone.
So you think that this is still a denial? We're still in denial in terms of what could happen?
I personally think that Greece is most likely to stay in the Eurozone. I think by the end of this year, Greece will still be in the Eurozone in some way, shape or form.
They want to be in the Eurozone.
However, if they do leave, I think the risk of them leaving is at risk of being mispriced. I think the reaction at the moment could be a form of complacency, and I may be part of that complacency. But I think if you look at market reaction at the moment, we've had single-digit drops for the most part. We've not had any huge kind of panic in real terms, and so I think at the moment people are expecting something to be pulled out.
But haven't we had like the nightmare announcement? But I think the Greeks want to sue the EU.
Yeah, but the Greeks have said.
Would they qualify for legal aid if they?
Yeah, well, yeah.
But I mean, I'm just saying it's that it could really unravel badly in the sense that it's not one thing or the other, and it's just a state of chaos.
Yeah, but I do think ultimately we have seen in the past we have come down to we've been at the 11th hour for the last 4 years. Yes, we may be closer to the 11th hour right now. But I do think that ultimately the ECB will step in and the institutions will step in to bail Greece out.
Okay, well, let's have a look at what you've brought to us for this morning.
Yeah, I mean, we had, just to kind of avoid the Eurozone a bit, and so German retail sales were fairly kind of robust. They increased 0.5% in adjusted real terms in May. I mean, the issue with lots of these kind of numbers coming out at the moment is not necessarily retail sales, although they are affected by kind of climate within the Eurozone. What happens in Greece may not actually affect the German consumer, but that sentiment does. But most of the sampling periods for the data that's coming out at the moment in terms of business confidence, in terms of consumer confidence, in terms of retail sales are sampled before Greece really started to kind of implode. German employment rates, etc. Italy kind of held at 12.4%, which is obviously still kind of astronomically high. But there was hope that they were going to see the gradual kind of decrease in that Italian rate. We've started to see an upswing in kind of business activity in Italy. We've started to see that that kind of business activity pick up. And, after we had such a freezing of credit, we had a freezing of loans to businesses, and now we've got huge amounts of cash being pumped in there from QE. We've started to see that, but it's not really feeding down to that upswing in employment rates. But we saw in the UK, we saw in the US that there was quite a significant lag between uptick in kind of business activity and getting rid of some of that slack in the jobs market. Actually, the big headline one for the UK, and it's kind of David Cameron's probably quite glad that we're not having the EU referendum anytime soon, given that current economic data is kind of making the case for him. We've got robust growth in the UK. We've had GDP growth revised up to 3% after the previous reading of 2.8%. We've seen gross fixed capital formation up by 1.5 billion. It's the highest since the ONS started recording that in 97.
Yeah, but doesn't that imply that things could? If we left the EU, what would GDP be? 7%, 6%? It looks as though things couldn't actually be any better than they are, even though we are semi-detached in it.
Yeah, that's the issue of what is seen in that is which is not seen. It is easy to, both sides of the argument, both sides can say we only have that 3% growth because of the EU, and the other side,
or because the EU is such a disaster area that everyone's come from the EU and is operating in the City of London.
There's plenty of conjecture to be made as to where that growth rate would be without the EU, but that
was just another story.
Conjecture. Eurozone unemployment. On the other side of the coin, making that argument for the people who want to get out of Europe is, we have 5.5% in the UK. In the Eurozone, it stayed steady at 11.1%. I mean, it's come down from 11.6 this time last year, but that's not exactly a huge kind of strengthening of labour markets in Europe.
So still dodgy, ropey, etc.
Exactly, yeah.
All right, next up are the European movers.
Yeah, I mean, we've seen the FTSE down 0.7%. Last time there were only 10 stocks that had made any gains in the FTSE this morning. Standard Chartered was the only one at 0.6%, which is kind of interesting given that Standard Chartered, of course, got so much Asian exposure and Asian markets aren't doing hugely well, although we did see that upswing as we've seen in the Shanghai Composite. You know, after the bloodbath we've seen over the last 10 days, there's a quite big swing in prices there. They lost 4.6%, and then they closed up 5%. So there's a pretty significant swing, which probably accounts for that Standard Chartered growth.
People's Republic of China's Treasury Department, Finance Department.
Well, exactly. I mean, we had that quote yesterday from one of the Chinese newspapers saying that the problem is that the average Chinese investor always believes that the Communist Party will step in to protect it and to help support asset prices.
It's like the Greenspan put, isn't it?
Well, exactly. And what's happened in China has only entrenched that, which is quite a worrying thing. You know, people keep talking about how leveraged the Chinese equity market is. The number of people who are trading, the number of consumers who are investing on margin, the number of people who are remortgaging their houses to invest in the equity markets, and that's always a scary sign. And the fact that the government stepped in once again to try and support those prices is probably only postponing any issues to next week or tomorrow or next month.
Kicking the can down another week.
Well, yeah, I think we've got to swear off using that phrase but yeah. And obviously Europe's getting nailed at the moment, understandably.
Okay, all right. Next up we have M&A.
Yeah, we've seen a bit of a upswing in futures markets ahead of, and this may have changed since we've gone out, given what's happening in terms of the vote. We have seen a bit of a strengthening here after the kind of negativity yesterday, and the argument is that we are going to see, there's likely to see a bit of a flight to quality in terms of global markets. Microsoft is quite an interesting one. They announced yesterday that it's going to exit ad sales, and it's contracted AOL to take over. It's kind of 9 biggest markets there. Microsoft have had a bit of a rough time trying to get into quite a tough market. I mean, the global kind of online ad market grew by 22.4% last year, but Microsoft saw its share of that decrease from 1.4% down to 1.2%. And for a giant like Microsoft to be at such a small percentage in such a kind of high competitive market, they're kind of cutting their losses, getting out of there.
Also, it can't be. Microsoft has to focus on its core businesses rather than trying to be everything, trying to be Google, Facebook, and everything in one company.
Exactly. 10 years ago, it would be unthinkable that a company like Microsoft would get squeezed out of a market like this, but that's creative destruction for you. Cisco is quite interesting. They got knocked down by the U.S. District Court, which put dampener on its merger agreement with US Foods, and so they're going to agree a $300 million breakup fee to just walk away from that deal because they know that the regulators are going to kill us off. So.
Okay. All right, and then what are we looking at? The data points?
Yeah, the Schiller House Price Index. We should see some strong numbers here. We had sales of existing homes were strong yesterday, up 9.2% year on year. So it's expected we're going to see a bit of a feed through into the case Schiller house prices. But it's kind of the expectation is we're going to see them at 5.4% year on year. But it's still within, we're not seeing overheating there, despite, we've still got record low interest rates, we've still got everything like that. And so, although we do have strength in that housing market, it's not overheating just yet. And we expect as well, we're going to see a slight slip in Chicago PMIs, but I think, as has been the case all week, we're going to be so dominated by what's happening in Greece and kind of sentiment there that we're not necessarily going to see a huge reaction in the markets. Okay, and just finally the levels. Yeah, I mean, some of the bigger movers in the pre-market, but again, everything, it's been the case, and it's been my kind of coverall for all currencies throughout this week, and since I've been covering for Darren, well, he's on holiday, and he's probably doing quite well
He's missed all the difficult ones.
Well,
Hasn't he?
he's also spending euros abroad, so he's probably feeling a lot richer right now. But again, what's happening in the euro is going to be driven entirely by sentiment. What's happening in Greece? We've not seen in currency markets. They haven't been that volatile. They could be. We could see a lot more movement. I think it's because of the degree of uncertainty. You know, people know that they can get their fingers burned in the markets, and so there has been.
So they're actually just standing aside.
Yeah, I do think. You know, I think there are some people who don't really know which way to call it, and so they're just standing out at the moment.
Right, okay. Well, that's it for the Wall Street Crossover Show with Craig Drake. We'll be back with the same type of recipe tomorrow.